Hey everyone, thank you for joining us today. Happy Friday. Hope everybody out there is staying safe and healthy. Appreciate you guys joining us on this Friday afternoon. You have myself speaking, Mark Stetson. I'm one of the producers here at O'dell Studner, accompanied by my colleague Kevin Turner, another producer and captive expert within our staffing practice group. We have Jerry Grady and Alison Dunleavy from UHY. Today we're going to walk through a few different topics. Kevin and I are going to begin with the current status of the insurance marketplace, which right now is a hard marketplace, and we're also going to talk about captive insurance programs and how you can utilize those to combat the hard markets going forward. So, and then also we're going to pass it to Jerry and Allison, and they're going to walk through Paycheck Protection Program, round 2 of that, and then also the Employee Retention Credit. If you guys have any questions, just feel free to put those in the chat. We'll address those at the Q&A session. Okay, here's a quick agenda. I'm going to go through the shameless self-promotion really quick on the Odell Studner side. Then we're going to talk about what is a hard market, what it means for your staffing company. I'm going to walk through just a quick overview of what that means for specific lines of coverage. And then also we're going to walk through the captive concept. So captive is one of those situations and topics we could spend an hour and a half talking about and scratch the surface there, but we're going to give a very high level overview of what that program could mean going forward for workers' compensation for your staffing company. We're going to talk about the mechanics of it, and then Jerry and Allison will love this, but also the accounting implications of what a captive could mean for your company. Who is O'dell Studner? We are insurance brokers and consultants. We're licensed in all 50 states. We're currently owned by Acrisure, which is a $4 billion agency that operates worldwide. We operate in 4 distinct verticals. Kevin and I specialize in staffing and work out of the staffing practice group. We're headquartered directly out of Philadelphia. Currently, to date, we represent a little over 115 staffing firms around the US, which encompasses 120 million in insurance premiums and about $4 billion in payroll represented. We are proud to say we're the largest captive insurance broker within the staffing industry and know captives really well. And we've paid out, or our captive programs have paid out $50 billion in dividends to date to our clients. Went ahead and through some of the associations that we're affiliated with down at the bottom of the screen here, but Florida Staffing Association, we also participate in the Mid-Atlantic Staffing Association, MSA, Inc., fastest growing companies, 5,000 staffing industry analysts, and ASA. Very heavily affiliated with ASA and SIA. You may see us at some of the conferences in years to come. All right, what is a hard market? So let me back up and say, some of you may be experiencing this as you're going through renewals for your insurance programs. You may notice rate increases as you're starting to review proposals from whether it's your incumbent carrier or even options that you've solicited from the marketplace. So the insurance marketplace goes in different cycles. You have hard market and soft markets. Right now, undoubtedly, because of COVID-19, we are in a hard market. What that means is you have a high demand for insurance products with a very limited supply, really shifting the powers to the insurance companies. They have stricter underwriting standards. There's a reduced capacity overall. I think a good example of the reduced capacity is what you've seen recently, if you guys follow the ASA bulletins, but World Specialty, who is the largest wholesaler in the staffing industry, has consolidated, and they were acquired by Philadelphia. And so now what you have is you have 2 of the largest markets in the staffing industry consolidating. What does that mean? Fewer options at renewal. The market just continues to get harder and harder as we're going through. We finished 2020 and pushing into 2021. You're gonna have fewer competitors, higher premiums, restricted coverage. That's what we're seeing across our book of business as we go through our renewal cycles. And like I said, some of you probably already are realizing this. Soft market is exactly the opposite. You have a lot of capacity in the marketplace, easier underwriting, it's easier to get deals done, more competitors, lower premiums, and quite frankly, just broader coverage overall. I think this graph does a good job just oversimplifying it. But right now we are definitely in a hard market state. This is a good graph to show you where we're at currently. So you can see, just walking back all the way through the early 2000s, right after September 11 attacks on the World Trade Center, you have a huge spike in all lines of coverage. And then that is followed by a steep downturn. And then right now, as you can see, we're seeing averages of 10.8% increases across all account sizes in all lines of coverage. So that's 12 consecutive quarters of premium increases. And again, this has continued into 2021. And I don't see this slowing down at least any point in the near short term. Hopefully things will settle down once we get out of quarantine and social distancing starts to alleviate itself. But right now, large accounts are impacted the most at 14.6% premium increases year over year. So what does that mean from an accounting standpoint? Just make sure you're accruing as you guys are approaching renewal. I would go ahead in the back of your mind, just start playing around with the concept that from 10 to 20% is typically what you're going to see just in the marketplace. That's what we're realizing, and that's what the research shows. By line of coverage, this drills in a little deeper specifically on what you can expect. Again, you can see the graph and the steep fluctuations quarter by quarter from 99 all the way up to 2020's data. And like, again, 2021 will continue to see this. We've relied on worker comp decreases. So workers comp rates have historically, the last few years, have accounted and been able to offset for increases in the other lines of coverage. Now that's not so much the case. You're seeing hikes across the board. So umbrella averages are up 20%. D&O is another big one, 16.8% in property as well at a 13% increase. So you have all of these increasing, and then you're not seeing the reductions in the workers' comp rates, even accounts that are performing well in the marketplace that have minimal loss exposures, loss ratios undeveloped under 40%, and 30% are even seeing flat renewals. So it's an interesting marketplace that we're in right now. You know, one of the reasons we brought Kevin on here today is to talk about captives and how you can use a captive program to combat these cycles in the marketplace. Kevin, I'm going to turn it over to you. You want to say something just so we can make sure you're on the mic here.
I am on the mic. Am I on the mic? Can you hear me?
Good.
All right, good. Hi, thanks everybody for coming in real quickly. Just to set the tone for the next couple of minutes, I want to let you know that this is not a presentation to sell you on captives. It's really just to kind of open your eyes to the captive concept in a very consultative forum. Captives are not a magic pill. There are some very good insurance salespeople out there that might make you think that, and they claim them to be, but they're not. This presentation will really focus on the mechanisms associated with one segment of captives right now. We're going to talk about group captives because that's the most popular form within the staffing space. There are numbers of group captives specifically created for the staffing industry. What I'm going to be talking about is more the owned group captive structure and where you become an owner in your own insurance company, which is really the focus. All right, Mark, you go to the next slide. I'm going to go through this really quickly because I think it's an important thing to cover whenever you talk about this. In most, if not all, group captive programs, you are taking risk. And since workers' compensation premium is your second largest expense, you're taking risk with your second largest expense. But with that risk comes rewards, but also a potential for additional costs. So let me make a clear statement as possible because I don't want this to be glanced over. If you do not feel you have control over your ability to control your annual work comp expense through any risk mitigation techniques, this is 100% not for you. I'm just making that abundantly clear. You are taking risk, okay? However, if you follow the basic principles of risk management, which I have listed here, and there are staffing business has some basic concept of risk management as well. And those three are how you pick your employees, how you pick your clients, and when you have a workers' compensation loss, what do you do? And by picking your employees, how do you weed out the predators? That's an example. How you pick your clients? Do you have a process for identifying prospective clients that could drive workers' compensation losses? And do you have maybe a way to monitor their work comp performance on an ongoing basis? And then lastly, I always paint it this way. If I came into your office tomorrow and nobody was around and an injured employee called, would I have a manual to look at to make sure that that claim was handled appropriately and all processes were put in place? Is there a good foundation for me, an unknown, to come in and handle a workers' compensation claim and make sure it gets handled properly? If you have those three things and you follow those basic risk management tenets, you'll be in a pretty good position to take risk. Okay, so the next slide. All right, let's go back to the hard market for a second. As you saw on Mark's chart, property insurance, D&O insurance, general liability insurance, you see all those things going up 10, 15%. If your workers' compensation expense went up 10 or 15% year over year, it's really going to impact your business. But you saw that work comp really hasn't moved too much into the increased portion of the graph. However, there are two things associated with the hard market that you have to be concerned about as a staffing company. It's not necessarily the increase in workers' compensation rates. It's the availability of insurance carriers that want to insure your business. And in the early 1990s, you saw on that chart, I don't know if Mark's chart went back that far, but there was a very hard market, 1993. And basically the insurance market completely turned their back on the staffing industry and non-renewed everybody. Everyone was in the same boat. So what happened is 13 staffing companies got together and said, we need to do something. They had two things in common. They were all staffing firms, and they all used the same risk management techniques and process when it came to managing their work comp expense. They worked with a company called Risk Control Services, who's now kind of defunct, but that was their reason for getting together. So tying the hard market to what's going on now, you may not be seeing a ton of increases in your workers' compensation rate, but the scary part is there are very few carriers out there that want your business right now, and some of them could be in financial trouble, and if they are, they're going to do one of two things. They're going to go belly up, or they're just going to cut industries that don't generate as much profits as they need. And what they do is they just cancel out an industry. That's my big concern. So a group captive is simply a group of companies getting together to make sure that they can get the group purchasing and pooling of resources together to share risk, but also share in the rewards. And what they do is, the concept is you retain the predictable losses within this group. All the group retains their predictable ones, and they transfer the catastrophic. Okay, and that's what these 13 companies did in 1993 when they got together. All right, Mark, next slide. So it's funny, I call it an enigma. Why would a staffing company join a captive? Well, to be honest, and it's true, it's cheaper to not buy insurance and handle insurance yourself. Okay, that's an enigma. It's like, but you're forced to buy it. So the problem in workers' compensation is, one, you can't not buy it. It's kind of illegal not to buy it. And two, even if you didn't buy it and you went self-insured, a monster claim or a very large claim could put you in financial risk. You can be in big trouble. So what you could do to kind of get a blending of those two things is you can emulate going on your own, through a group captive concept. But the problem is, there are a lot of mechanisms and a lot of things that could either get in your way to do this process, but there are other things that may entice you to do this process. And what I'm going to do is I'm going to kind of walk through a little bit of what that process is. Okay. All right, Mark, next one. So I like this slide because I thought it was a great graph. What you can see here is, it says the emergence of a leader. And I kind of say that tongue in cheek, but in 1993, when these 13 companies got together, they could have done one thing. They could have just swallowed the pill and decided that they're all go off the cliff together and have tremendous increases in their costs and just, cater to the whims of the insurance community. Or they could, reality, decide to do their own thing. And what they ended up doing is they said, hey, we're best in class. We're going to lead the standard market. And we want to get protected from this hard market issue that may be coming down the pipe, or in their instance, when it did happen. So they all got together and said, whoa, wait a minute, we can do something different. And and that is becoming more of the norm as opposed to the traditional marketplace where you go buy insurance and you transfer all your risk to like an AIG or a Sun's Insurance or one of those programs. The issue is when the best in class companies leave the market, all you're left with is increased insurance costs. You as a staffing firm are getting poorly performing companies. You're at the mercy of these market swings that Mark was talking about. And one of the key aspects of becoming an owner in your own insurance company is you want control. And the worst feeling in the world when the workers' compensation market hardens is that loss of control that you feel, that anxiety you feel, that you've done everything right in your business, and there's nothing you can do about it. Okay, Mark, next slide, please. So I'm not going to go through all of these things, and Jerry, I think you can provide a copy of this presentation, but I'll just tap into two things. Really, the reason to join a captive is you want to get control. You want control of your insurance destiny, and that's one way to do it. Okay, there are numerous opportunities out there to purchase insurance. They still exist today, but they could disappear at any time. So if you want to position yourself to kind of alleviate that renewal headache, you can position yourself to at least explore an option at a captive. But there are so many reasons not to join, and you can see the list there. But really, the biggest one is some people don't want to be in the insurance business, or you really, really actually like the carrier that you have and the claims people that you have, and you feel you've got a good partner already. Okay. Now, there are a few carriers that only specialize in staffing. I would say that's a good partner. What I would recommend is just do not fall in love with your insurance carrier. Who falls in love with insurance carrier? Don't trust your insurance carrier, okay? Because at the end of the day, they're in business, and if they don't see his industry as profitable, they'll just cut you off. So those are the two things that you want to think about, and why you want at least to put captive concepts into your thought process. All right, let's go through them. How am I doing on time, Mark?
You're doing good.
Good, okay, all right. So I'm going to, as I said, do the Cliff Notes version of captive mechanics. Sometimes I think the best way to do it is for those of you listening in to kind of give yourself a visual here. And let's just quickly, we're going to use a sample staffing firm who currently pays $500,000 in what we call guaranteed cost insurance, where they transfer all of their risk to an insurance company. That's how they used to do it. All right. And historically, that staffing firm averages about $100,000 per year in workers' compensation claims losses. Okay. And they're running about $10 million of payroll each year, and each year over the last 5 years. So it's a nice size regional staffing firm that does have some work comp loss history, but overall they've been performing what looks pretty well because they have $100,000 in workers comp losses, and they pay $500,000 in premium. You're a wonderful, wonderful account for the insurance community. They would love you. The issue is insurance carriers are very tied to what rates they can charge. And no matter how much you have in losses, if your experience mod can only go down so much, maybe you're locked in at only getting your premium down to about $500,000. Maybe that could be the reality. So what you can do is you can take yourself out of that reality to that extent. Okay, what the captive will do as far as the mechanics go, you're going to take a look at your history and determine an appropriate bucket of money to pay for your estimated losses for the year. Okay, just so picture just a bucket of money, okay, that they're going to put together. They're going to, and then secondarily, they're going to look at the entire history of the group captive that exists out there, and they're going to determine another bucket of money to pay for what we call unpredictable claims. So there's one bucket of money for you as an individual staffing firm, and there'll be another bucket of money to pay claims for any what we call catastrophic losses. So you have two buckets of money there. And then based on that, the captive is going to add in the cost of running an insurance company. And there are costs associated with running a captive, paying brokers, paying what we call third-party administrators to handle claims, offshore expenses, reinsurance, excess insurance. All of those things get added in order to create a nice bundle of services to make sure that the captive insurance company runs effectively. And then what they've determined is that's the insurance premium you're going to pay to the captive, okay? And it's been determined based on your history because you have a bucket that is yours. And this process happens year over year, all right? Hopefully that kind of gives you a visual. So you have your premium is 3 buckets of money. Frequency bucket for you, pays claims. Severity bucket for the big one for the whole entire captive. And then the fixed cost bucket, and that's a bucket of money that goes to other people, okay? That's your fixed expense. All right, Mark, next slide, please. Okay, so everyone hears about captives and they talk about getting your money back. Okay, what does that mean? So let's go back to that $500,000. And that $500,000 is split to 3 buckets of money. You have your fixed expense bucket. That generally, in the group captive concept, revolves around 30%. Okay, so that $500,000, $175,000 is going away. That's going to pay expenses. Okay, then there's your money, that other 65%. And that 325 is split into 2 different buckets. There's a predictable bucket up to $150,000. And the unpredictable bucket, this is where you share a lot of your money, is the $75,000, and that's for the group to share in what we call unpredictable or large losses. Okay, if you have a normal year for $100,000 in claims in this scenario, you're potentially looking at $150,000 return premium. Now, there are a lot of different details that go along with how you get the return of money, but quite simply, in the simplest terms, you have $250,000 in your bucket, you have $100,000 in claims, you're going to get $150,000 in return premium. Okay, that's how it works. And to just add on a little thing, when you become part of a captive, you become an owner in your own insurance company. You get a share of stock. You get 2 shares, a common share and a preferred share. The common share gets the bills, they pay the premiums, they pay any potential audits, they pay some assessments if they come due. And then there's a preferred shareholder, and that $150,000 of return can go to the preferred shareholder, it can go to an owner, it can go to a trust, it can go to a lot of different things. So that's a really nice thing to have, that you don't have to bring the money back into the company if you don't want to. And secondarily, just a little note, if the captive as a whole has no claims that hit that unpredictable bucket, the large claims, that money is returned as well. That being said, there's always a large claim, and sometimes the money gets wiped out, sometimes it doesn't. So that's why it's separated out as a unpredictable bucket. So we don't really know what's going to happen to that amount, but it could be there. All right, Mark, next slide. Okay, this is where the rubber hits the road. So same captive premium of $500,000, and you see the splits. As you can see, of the money that the 325, you also have the predictable bucket of 250. All right, the money you get back if you perform well. There is a situation where if you have that $250,000 and you have losses and all that money gets eaten up, the captive can come back to you for more money. In this particular captive that we're talking about, they can come back to you for an additional bucket of money, plus a little bit more. Okay, so there is a situation because maybe you made a conscious business decision to do some business with someone that you knew maybe was going to have some losses. You're going to end up paying for it. Okay, and because there is potential upswing in costs, there is credit risk to the captive because they're not funding in for the eventuality that you might blow through the bucket of money. So the captive is exposed to credit, basically an uncollected exposure to loss. So in order to protect the captive, what they do is they generate collateral. And it's a very, very predictable number, okay? That being said, it's an additional cost element associated with the captive. And when I say cost, it is money that is not at risk. They ask for collateral. It's money. It could be something where you could post a letter of credit, but it would tie up your credit line. So what it does is it kind of squeezes your availability of cash to your company for the first 3 years that you're in the captive. And I don't want to go too much into detail, but there is a collateral element associated with this. And I'll tell you one thing, it's the number one reason most staffing firms decide against making the move in. They just either they can't afford to post the collateral, they don't want to stretch their cash because their margins are too tight, so they operate a very tight ship, or they don't want to post a letter of credit because they rely on their bank line so much and they don't want to tie up that. Those are, I mean, and that's really the main decision point before you even go into a captive, is to kind of get an idea of where you stand from a cash position, and are you willing to make a long-term decision instead of a one-year decision. Okay, that's kind of the captive mechanics in a nutshell, very quickly. It's very hard to not go into detail. I tried to give you a broad overview. But, you know, mostly to kind of put a bow on the presentation, a group captive concept or any captive concept is you have to be prepared to take risk. And then what you do is if you implement the captive concept into your broker's marketing of your insurance, something that you want your broker to explore, what you're doing is you're positioning yourself to educate either your ownership or your CFO on different alternatives and financial tools to look at insurance. Okay, it doesn't always have to be just pay the insurance company and you know, transfer all your risk. There are other things you can do, and most owners that I know, they want choices. And having a choice between guaranteed cost programs, that makes it pretty easy. Let's generally go with the least expensive one, and hopefully they have good claim service and loss control. Okay, but it would be nice for some CFOs and some ownership to think, okay, I have this guaranteed cost thing, but maybe I want to look at this thing over here. It's a very different concept. It's very unique, and at least it will allow me to look at myself as a staffing firm and say, how comfortable am I with my risk management program? And do I want to control my own destiny, or do I want to put the destiny in the hands of the insurance community? Going back to that hard market thought process. And that's all I have from a captive concept. Go on it. I'll just touch on the accounting implications a little bit. You know, I always worry when we have accountants on the phone to go into this concept, but I'll touch it briefly. So the good thing is the captive premium is fully tax deductible. It's treated as insurance, and that is set in stone. There is pooling of risks, and there's risk shifting and sharing within the captive. The collateral is not tax deductible. Some of the downsides to the captive is it does complicate the balance sheet and income statement a little bit. How do you capture the cost and the expense? How do you treat the return of money? How do you accrue potentially for that additional expense if you do blow through and someone asks for that additional bucket of money? I mentioned there is a share of stock, a preferred share, and a common share. You're going to have to get your accountants involved to see how you're going to structure that. As I said before, the preferred gets all the good stuff and the common gets the bad. And there's another thing that you would want to make sure that your financial advisor looks at is, and it's a beautiful thing with certain captives, this one we're speaking of, the bucket of money that I had you visualize, that money goes somewhere. into what we call a captive investors fund. It's $1 billion fund, highly managed, high-level money managers. Okay, and what that money is doing is giving you a return on that investment. Okay, your premium dollars go in there, and the collateral that you post goes in there. And the historical numbers are an average return of 7%. You know, obviously you can't guarantee that, but it's a good number. And you're going to win some years and lose some years. But what you're doing is you're actually getting a return on your investment of that money. So there are some unique aspects of the captive that, once again, have it in your portfolio. Talk to your insurance broker or your insurance consultant about saying, hey, maybe I want to explore this. Okay, and that's to present. That's really just as a hedge to what could happen during a hard market. All right, Mark, that's all I've got.
Good deal. Jerry, I'm going to pass it over to you now.
Thanks so much, Mark. Really appreciate it. Kevin, thanks for all that good stuff. Really appreciate it. And I don't mind when you are definitely talking about accounting work, because it really does. It really helps. It really helps us to be able to do what needs to be done, because it is a very complex area to live in and do. Why isn't this working? Is my screen showing up for you guys? It is? Okay, good. All right. So thanks everybody for being here. What we're about to go through is going to be speed dating. PPP and ERC in 20 minutes or less is an unbelievable time frame, but we're going to do it because we see a lot of need for this. Most of you know who UHY is. We are a CPA firm, based nationwide firm. I help and run the staffing industry practice, and Alison Dunleavy is one of our tax experts and senior managers in the practice as well. I'm going to quickly go through PPP I and PPP II, and then Alison's going to give you an overview of the employer retention credit. Please understand that both of these are tied directly together, and they're both complex when you're looking at 2020 or looking at 2021. So I encourage you to make sure you try to pay as attention as best you can, but we will get these presentations out to you if you would like to have them. So let's talk about PPP I real fast. Overall size of every loan out there was about 101,000. If you look, 68% of all loans that were sent out in PPP I were 50,000 or less. And when you get down to the million or over, only 2% of the entire loans given out to the public went to dollar amounts over $1 million. So they used this stat to figure out that for PPP II, where the real need was for those under $2 million. And so that's why they came out with a $2 million number, that you could not borrow any more than $2 million. So PPP I, some of the updates that came out. The big update is that if you did not get the maximum dollar amount that you should have gotten in your first round on PPP I, you are able to go back and get that money. This has happened to quite a few companies that we have looked at, staffing firms, where their LLC, the members did not get their portion for their guaranteed payments. So I encourage all of you who have an LLC and take guaranteed payments or had income in 2019 to consider going back and looking. Depending on the number of partners you have, the potential is about $21,000 per partner that you might be able to get that you did not receive in PPP I, because that question did not come up until later around May, when they put some more clarification out. In addition, the EIDL grant. This is something that's extremely important. Many firms did get a $10,000 EIDL grant, and that grant will no longer have to be paid back. So if you've already done your application, that $10,000 will now be able to be forgiven, and the SBA will do it automatically for you. You don't have to do anything. So if you've already gotten forgiveness, you've turned in everything, the SBA cleared you and sent you a bill for 10 grand, the SBA is going to wipe that off. You will not have to worry about that. In addition, they have added additional allowable expenses for loans that have not yet been forgiven or applied for forgiveness. And we're going to talk about those in a minute. So PPP I compared to PPP II. The PPP I, as everyone remembers, used a very strong word that was called a small business concern. So even though that it was for companies with 500 or fewer employees, they used the small business concern as the definition, which allowed many staffing organizations to go out immediately and grab the money because they were under $15 million in equity and under $5 million average net income for the past couple years.
Hey, Jerry,
However,
those slides aren't moving.
Oh, they're not?
No.
How about now?
There you go.
Which one am I on?
You're on eligibility, PPP I, PPP II.
Got it. All right, sorry guys. PPP II, they changed it. They said any business concern. And what that did is that took the alternative method that was placed in PPP I out of the formula. What does that mean for many staffing firms? Unfortunately, PPP II is only available to those that have no more than 300 employees, and that 300 employee total is an average, and it's also must include all your affiliated companies. In addition, you also have to demonstrate at least a 25% reduction in gross receipts in either the first, second, or third quarter of 2020 relative to 2019. However, if you also showed a complete greater than 25% reduction in overall gross receipts for the whole year, you will also qualify for that 25%. So it's either 25% for a quarter or 25% for the whole year. Been a lot of confusion about that, but those are the two rules that you can look at, because we had many staffing firms who might have been at 24% one quarter, 10% reduction in another quarter, but for the end of the year, that came out to about 23 or 26, 27% for the end of the year. So they were able to apply. Others might have had a 25% reduction for quarter two, but then 3 and 4, they went up 45 and 50%. So you really got to look at this, because some people thought they could not apply because they were not under 25% for the year, but it was really based on a 25% for the quarter. PPP I eligibility, this is what they cleared up. You have to be a operating business as of February 15th, 2020 to qualify, and you cannot be permanently closed. So if you were in business before February 15th and you applied for a PPP I and received that PPP I, and you are able to go back for a PPP II, then you will be able to do that. So that's the key, is February 15th, because there were many businesses started in 2019 or 2020 that were not started till summertime. Unfortunately, if you started anytime after February 15th, you're unable to go in for PP1 or PP2. Let's talk about gross receipts. This is an area that each bank, because they usually are outsourcing the testing mechanism in the application, you have to put some thought process in there. The way it is worded, it says gross receipts include all revenue in whatever form received or accrued in accordance with the entity's accounting method. Now, for most people, when you hear that word accounting, you think we're talking about GAAP. That would be your first thought. However, inside the actual law, it states are defined and reported on IRS tax return forms. So what that means is that they really are looking at it based on what your true overall tax methodology is. So you could be accrual for your book purposes, but you could be tax or cash for your tax method. So you really do need to talk to your advisor and talk to your bank. But we have been able to show certain banks that by providing them with their gross receipts from their bank statements from 2020 compared to 2019, we have been able to get the loans through because they file based on a cash basis for tax returns. You could run into a situation where your bank says, we're not going to use the tax return because you provided to us the financial statements on a quarterly basis that were an accrual, so we are looking at it from those numbers you provided us. One thing that's important to note for those of you that have sales tax in various states, the taxes collected for and remitted are not included in your gross receipts. However, the proceeds from transactions from your affiliates are also not included. So if you have two staffing firms and those staffing firms actually bill back and forth from one another, you do get to remove those gross receipts from the staffing firm that earned it from the other staffing firm. In addition, you cannot exclude any reimbursable expenses. So if you have some contractors you're using, you can't do what we used to call the old netting effect. You still have to have the dollar that you receive for that subcontractor to be out in the field. You do have to use that dollar. Again, if you are calculating your gross receipts, you must add all affiliates across the board. I will just quickly tell you that affiliates in the simplest term is if you own 2 or more entities and you own more than 50% of each of those entities, you are most likely an affiliate. It's not as simple as that, so you got to check with your advisor, but that is usually your starting point, is 50% or more common ownership in each entity. If you did acquire somebody or you were acquired in 2020, those gross receipts will need to be included for each period. So if you acquired somebody, you do have to go back and get their 2019 gross receipts because you have to look at both sides of the table here, both the 2019 for you and them and the 2020 from you and them. However, if they are segregable business division was acquired, then the gross receipts do not need to be counted. A segregatable business would be something that is completely different than a staffing firm. So if you acquired another division that had nothing to do with staffing at all, then you are not going to have to add in their gross receipts. And again, just so everyone remembers, PPP money is not considered gross receipts because we've had a few clients actually send it in because it was on their bank statement. They sent it in that way. Cover period, they defined it a lot better, that it is any 24-week period from the starting point of the funding of your loan. So you can actually choose any period that is not less than 8 weeks from the date of origination of the loan, but no more than 24 weeks from that date. So if you get to 15 weeks and you feel that you've met the forgiveness side of the application, you're able to go ahead and file. There was some confusion on that, so they made it a lot stronger and wrote it right into the law. Now, for PPP I, you were able to get 2.5 times your average monthly payroll cost for calendar 2019 or the trailing 12 months, whichever you chose. For PPP II, it's the same way. However, for PPP II, if you're looking for ease and you did not increase your payroll in 2020, then utilizing your 2019 data is what you're going to use. We are recommending that everyone take their 2020 application, they grab all the information they have, They then request the same dollar amount they did in 2019. And then that way, if the bank does ask for any more documentation, you have it ready. However, if you are going to use 2020 payroll because you will get an increase in that PPP loan, you will need to pull all new documentation for that loan. And as I said, the maximum is $2 million for PPP II and $10 million for PPP I. Now, the big, huge item for all staffing firms that I want to point out on your forgiveness application is 2D, E, and G. Those items are now able to be added to your application. And what does that mean? It means if you happen to be in any one of the protest areas and had damage to your building or your operations, those costs get to be added. If you pay for an ATS system on a monthly basis, you pay for the recruiting system such as Career Builder or LinkedIn or Indeed, those monthly costs are now able to be added. And if you redid your entire office with either, segregating employees, putting in new, plastic sheaths, buying masks, PPP equipment, all those costs get to now be added into your non-payroll cost. And the reason that is so important is because when Alison talks about the ERC, it definitely adds the ability to take your PPP cost, decrease your payroll cost down to the 60% requirement, and then have the ability to take an ERC credit, which for many staffing firms could become even more free money for you. I do want to make sure that all of you understand that PPP II does have a current economic uncertainty that you do have to answer. But what is unclear is whether that safe harbor will apply for PPP II the same way it did for PPP I, meaning that all loans under $2 million automatically were safe harbored from that certification. It is something that we are having very strong conversations with our clients in determining whether they really should go get a PPP II, because there are many staffing firms that, while they did suffer dramatically in Q2 and Q3, Q4, Q1 of this year, things are turned around, their cash flows are a little stronger, their line of credits didn't get reduced. There could be a situation where the SBA comes back and says, we're going to make that $2 million safe harbor, we're going to take it all the way down to $500,000. So just something for all of you on the call to think about. They do have an extremely simplified application process. There has been a couple comments out on ASA the past couple weeks about this. All loans under 150,000 will be automatically forgiven. It is a single form that they're coming out with that will reflect. It's application 3508. Please be on the lookout for it if you are under 150, because it is coming. And but many banks have held up processing any loan under 150,000 because they want to have the streamlined process as well. And literally, you will be sending in no documentation whatsoever. Last item we wanted to talk about, they clarified what the benefits are: group life, disability, vision, and dental insurance. Those have been added for your compensation. The safe harbor has now been to the end of the cover period for PPP II or PPP I, since December 31st, 2020 is no longer there. The big item, forgiveness amount is not taxable, and all the deductions you paid are now able to be deducted. So I do want to get to Alison. I want to respect everybody's time. So I do want to get to Alison's information on the employee retention credit so that she can provide you with some insight on what else is available to staffing firms.
Thanks, Jerry. I will try and be as quick but as thorough as possible. Again, we can always send out the slides or have further conversations offline. I'm pretty sure that all of you have heard of this employee retention credit. And The definition of it is eligible employers may take a credit based on qualifying wages. The amount of the credit is 50% of wages, capped at $5,000 per employee for the year 2020. The wages include applicable group health insurance, and then the calculation of the qualifying wages will depend on the number of employees of the employer. So eligible employers may take a credit based on qualifying wages. Let's see what the definition of eligible employers is. Eligible is if you were fully or partially suspended, or your operations were suspended during any calendar quarter of 2020 due from government orders. The important part here is that it needs to be from a government mandated order. Or you experience a significant decline in gross receipts during the calendar quarter. Partially, so the operations, your trade or business is partially suspended, again, has to be at the determination of a governmental employee or a governmental agency, excuse me, due to COVID-19, such that the employer can still continue some, but not all of its typical operations. That's what partially suspended means. There are many, many examples in the IRS FAQs that go through very, detailed questions. The big thing I think of is hospitals, where hospitals canceled elective surgeries. They're, required or emergency rooms, those stayed open. So that would be a partial shutdown. They were able to continue some, but not all of their operations. So just like with the PPP II, you will also need to aggregate anything that is commonly owned. So whether it's a parent or subsidiary controlled group, brother, sister, combined group, these are determined by ownership. And like Jerry said, parent corporation owns more than 50% of the total combined voting power in all classes of stock, or more than 50% of the value of all classes of stock for each corporation. So you need to look at everything on, what's under your umbrella.
Sorry, it's stuck again. Hold on, I gotta fix this. What is going on? Okay, this isn't working. Sorry, guys.
Let's see, I have.
There you go, I got it.
Oh, okay. All right. So again, the aggregation rules apply to all types of businesses: partnerships, trusts, estates, sole proprietorships, anything under common control. Entities, they would be considered a single employer if they're under common control, applying rules similar to the parent subsidiary or brother sister controlled group. Under IRS rules, an affiliated service group is treated as a single employer based on rules related to the performance of services by one entity for another entity, or by one entity in association with another for third parties, even if the entity does not have sufficient ownership or control the other entity to form a controlled group. So if you have a related company that provides you back office services, you'd have to make sure you looked at these rules, because you could be deemed an aggregate one business. Now, what is significant decline in gross receipts? So it begins with the first calendar quarter in 2020 in which an employer's gross receipts are less than 50% of its gross receipts for that same calendar quarter in 2019. And then the significant decline in gross receipts ends with the first calendar quarter that follows the first calendar quarter in which the employer's 2020 gross receipts are greater than 80% of its gross receipts for the same calendar quarter in 2019, or with the first calendar quarter of 2021. So
I think you should say that one more time, Allison, because I'm still trying to make sense of that. So let's give them an example.
let's give them an example. All right. So if you look at here, right in the middle of the slide, calendar quarter 2020, calendar quarter 2021, or Q1, excuse me, 100,000 gross receipts over 2019, 210,000 gross receipts. So as you can see the percentages, so employer one had a significant decline in gross receipts commencing on the first day of the first calendar quarter of 2020. So the gross receipts were less than 50% of that in the same quarter of 2019, and ending on the first day of the third quarter of 2020. And this is the quarter following the quarter for which the gross receipts were more than 80% of the same quarter in 2019. So employer one is entitled to a retention credit with respect to the first and second calendar quarters. In simplistic terms, if you qualify for Q1, you qualify for Q2. If you qualify for Q2, you qualify for Q3. Now, again, the aggregation rule. To be an eligible employer on the basis of a significant decline of gross receipts, because remember, it's if your businesses were limited or significant decline of gross receipts, the employer must take into account the gross receipts of all members of the aggregated group. If the aggregated group does not experience a significant decline in gross receipts, then no member of the group may claim the ERC. So the next slide will show you that while company J showed a sharp decline, company K made up for it, and therefore they would not qualify. Now, employee test. For an eligible employer that averaged more than 100 full-time employees in 2019, qualified wages are the wages paid to an employee for time that the employee is not providing services due to either a 1, full or partial suspension, or 2, the business is experiencing a significant decline in gross receipts. What it means by not providing services is if you basically paid that employee to stay at home and not work. For an eligible employer that averaged 100 or fewer full-time employees in 2019, qualified wages are the wages paid to any employee during any period in the calendar quarter in which business operations are fully or partially suspended, or you're experiencing a significant decline in gross receipts. Unfortunately, with the staffing industry, many of you have more than 100 full-time employees. So this would only be applicable to you if you were paying employees to sit at home and do nothing, basically. How to calculate the wages. The term full-time employee means an employee with respect to any calendar month in 2019 had an average of at least 30 hours of service per week or 130 hours of service for the month. This is also the ACA rules. An employer that operated its, oh, okay, just kidding. So to get the average number of FTEs, you would basically add up all your employees for 2019 and just divide that number by 12. Qualified wages are wages as defined by the Internal Revenue Code, both determined to the contribution and benefit base as defined under section 230, paid by an eligible employer to some or all of its employees after March 12th and before January 1st of 2021. So basically any wages you paid to your employees between March 12th and then December 31st of 2020. The wages do include the healthcare costs too. If the eligible employer averaged more than 100 full-time employees, you are not allowed to include any PTO, any vacation time, any sick time, as this is time that is deemed to have been earned prior to that March to December timeframe, and therefore not eligible. If you are under 100 FTEs in 2019, you are allowed to include all time, whether it be vacations, sick days, PTO, those types of things. Severance, the IRS is taking the same position as they are with PTO, sick days, vacation days. Those are not includable as qualified wages because it was for past service and not the time worked between the March and December timeframe. You cannot pay wages to related individuals. So, you can. If you do, they do not qualify for the ERC. So brothers, sisters, children, aunt, uncle, etc. However, it is important to note that because the IRS makes business owners take a reasonable wage, we feel that you as the owner would be able to include your wages as part of the qualified wages that would be eligible for the ERC. No double dipping. So you can't use the same wages for FFCRA and then use those same wages as part of your forgiveness calculation. And if you have a work opportunity tax credit on an employee, you are not allowed to use their wages during that period either. You can only take one or the other.
Allison, what I'm going to do is I'm going to go ahead and get to the 2021 changes.
Yep.
So there you go. Oops, sorry. So that because we are starting to hit time.
I know. Sorry, guys. I promise it'll be quick. The good thing is that while all those crazy restrictions in 2020, the IRS has loosened up what I'll call the rules for 2021. So this credit now is extended through June 30th of 2020. The amount of credit you can receive increases to 70% from. It lowers the threshold for the decline of gross receipts down to 20% from 50. And lucky for the staffing industry, it increases the number of full-time employee tests from 100 to 500. Same thing, no double dipping. Can't use it for PPP forgiveness too. If you get a second round of loan, you can't use the same wages to qualify for the credit. But in this case, if you have an employee that qualifies for the work opportunity credit, you just can't use those wages that you're using to claim the WOTC in addition to claiming the ERC. It also adds a couple other sections, as you can see below. You can get advance payments, and you would have to fill out a form for that if you didn't have the money to, pay those qualified wages. You could, it's Form 7200, and how you get the credit is you basically you'll claim it on your 941, your employee tax filings, and you will withhold that money that you would have paid to the government. And I'll throw it back to Jerry. Apologies for the overage.
Nope, Allison, I got to say that that ERC, you did a great job of explaining that in 15 minutes because it is not an easy concept to understand. We wanted to give everybody on the call more of an overview because there is a lot of detail. the fully and partially suspended operations. The examples, there's about 20 some odd examples in the IRS guidelines for that. So if you may not have been able to claim the credit because you didn't have the gross receipt reduction for 2020, you might want to look at maybe the fully and suspended, especially if you're under 100 employees. We do believe that for the staffing clients, the 500 employee count now just opened up a tremendous amount of opportunities for staffing firms to be able to get some credit during the 2021 year because of the fact that they were eliminated from the PPP round. So it's something that we encourage all of you to look through, understand. If you need us, here's our information. We have no problem actually providing you with whatever data you need. I want to take the opportunity to thank Mark and Kevin. Guys, as always, it's great whenever you're on the call with us. I love hearing about the captive. I think you guys do a great job because you do provide us with great insight into what's in the marketplace. And it was a great presentation, and I encourage everybody to really be careful. I'm with O'dell Studner on this one. The market is hardening, and it's hardening fast. And I think that there's a lot of opportunity for all of you. So with that, we'd like to say goodbye. We appreciate everybody on the call sticking around for the whole time with us. And we look forward to our next session, which will probably be sometime in April. Thanks so much, everybody. Appreciate it.
Absolutely. Thank you, guys.
Thanks, everybody. Thanks, Jerry. Thanks, Alison. Bye-bye.
Thank you.